The eighth learning objective is to estimate ending inventory. The eighth learning objective is to account for periodic inventory using the three most costing common methods. Accounting is simpler in a periodic system because the company keeps no daily running total of inventory on hand. The only way to determine the ending inventory and cost of goods sold in a periodic system is to count the goods, and that's usually at the end of the year. The periodic system works well for a small business in which the inventory can be controlled by visual inspection. That is, the inventory usually is not large in size or dollar amount. The periodic system uses 4 additional accounts: purchases, purchases discounts, purchases returns and allowances, and freight in. Purchases is the account that holds the cost of inventory as it is purchased. Purchases carries a debit balance and is an expense account. Purchases discount is a contra account and it carries a credit balance. Discounts for early payment of purchases are recorded here. Purchases returns and allowances. This is also a contra account and carries a credit balance. Items purchased but returned to the vendor are recorded in this account. Allowances granted by a vendor are also recorded in this account. Freight in. This account holds the transportation cost paid on inventory purchases. It carries a debit balance and is an expense account. In the perpetual system, all of these costs go into the inventory account. The cost of goods sold is determined as follows. Beginning inventory is the ending inventory from the preceding period. Net purchases, often abbreviated as purchases, equals cost of goods available for sale, minus ending inventory on hand at the end of the current period equals cost of goods sold. In purchases, we do have to figure out, this is net purchases, so we do need to figure out the discounts. We need to subtract the discounts, the returns and allowances, and we add freight in to get net purchases. The various inventory cost and methods, LIFO, FIFO, and average, in a periodic system follow the pattern illustrated earlier for the perpetual system. For all 3 inventory costing methods, cost of goods available is always the sum of beginning inventory plus net purchases. The different methods, FIFO, LIFO, and average cost, compute different amounts for ending inventory and cost of goods sold. In other words, the $773 invested in cost of goods available for sale will be either on the balance sheet in inventory or expensed on the income statement in cost of goods sold. Under FIFO, the ending inventory comes from the newest or the most recent purchases. Periodic and perpetual are always the same for FIFO because FIFO sells oldest inventory acquisitions first. Therefore, it does not matter when FIFO is calculated. The first purchase will always be the same whether we calculate cost of goods sold on the sale date, which is perpetual, or at the end of the period, which is periodic. Under LIFO, the ending inventory comes from the oldest cost of the period. In this case, the beginning inventory of 2 units that cost $40 per unit plus the first purchase at $45. In the average cost method, we compute a single average cost per unit for the entire period. 773 divided by 17 units equals $45.47. Then we apply this average cost to compute ending inventory and cost of goods sold. Purchases are debited for inventory purchased during the period. Accounts payable would be credited. When returns are made, we debit accounts payable and credit purchases, returns, and allowances. This will accumulate all returns or allowances granted in one account. If the invoice is paid within a discount period, a credit to the purchase discount account would be made at the times of a payment. This is similar to sales discounts, but rests on the company's books of the buying company. The 4 new accounts would be closed out at the period end. Cost of goods sold, inventory, purchases, returns, and allowances, cost of goods sold. Exercise 6A1 reviews how to compute inventory amounts. We're looking to compute the periodic inventory records of Synergy Prosthesis indicate the following at July 31st. At July 31st, Synergy counts 2 units of inventory on hand. Compute the ending inventory and cost of goods sold using each of the following methods: average, FIFO, and LIFO. For the average, we take the $1,820 spent divided by the 26 units to come up with the average. We take the average cost, which is $70, multiplied by the 2 units on hand, gives us $140. The goods available minus the ending inventory, the cost of goods sold is $1,680. Under FIFO, that's first in, first out, the 2 units on hand would be valued at $85 each, for a total of $170. $1,820 minus $170 gives us a cost of goods sold of $1,650. LIFO, we have 2 units on hand valued at $60 each. That's $120. $1,820 minus $120 equals $1,700.